The most common path to financial ruin begins with a correct assumption about price, but a catastrophic misunderstanding of time. You see a level where the market has previously turned, a historical bottom, and you believe it to be a foundation of solid steel. You place your capital upon it, expecting it to hold. When it breaks, you are not merely wrong. You are a victim of your own ignorance of the supreme law of the market. Time governs all. A support level is not a floor. It is a memory. And memories fade. The universe, and by extension the markets which are a reflection of human nature within it, is governed by mathematical law. It is not an arena of chance. It is a grand clockwork mechanism, precise and predictable to the one who has done the work to understand its construction. The uninformed speculator sees only chaos, a frantic and random series of upward and downward ticks. The student, the market mathematician, sees the sublime order beneath. This order is the law of vibration. Every stock, every commodity possesses its own unique rate of vibration. It is this vibration that creates the cycles, the patterns, the geometric forms you observe on a chart. A previous bottom, the subject of our study today, is a point of immense significance. It is a point where the vibration of selling pressure was completely exhausted, and the vibration of buying pressure asserted its dominance. Think of it as the lowest point in the swing of a pendulum. At that exact moment, the downward force is zero, and the upward force begins to take control. This point in price and time is recorded in the market's memory. When the market returns to this price level in the future, it is not a coincidence. It is a test. The market is returning to a harmonic point to see if the same balance of forces exists. It is testing the integrity of its own geometric structure. The uninformed gambler treats this test as a certainty. They see the price approach a previous low and they buy blindly. They are betting on a single data point, price, while ignoring the far more powerful dimension, time. This is a fatal error. The support level is a coordinate, comprised of both price and time. To ignore the time factor is like trying to navigate the ocean with only a knowledge of latitude, but not longitude. You will be lost, and your capital will sink. Let us construct a mental image. Picture the chart of December corn. Last autumn, after a long decline from its summer highs, it found a final resting place at $4.70 per bushel. This occurred in the second week of October. This point, 470, second week of October, is now etched into the structure of the corn market. It is a foundational point. For months, the price rallied away from this level, moving upward in a clear and measurable trend. Now a new season is upon us. The price of December corn has been falling for several weeks. It is now approaching that same $4.70 level. The gambler, the one who relies on hope and guesswork, sees this and prepares to buy. He tells himself, it held in October, so it must hold now. This is not analysis, it is a guess based on a lazy observation. The market mathematician, however, asks the critical questions. First, what is the time? How many weeks or months have passed since the last bottom was made? Has a major time cycle completed? For example, has it been 180 days, or a full 360-degree cycle of a year? The time elapsed between the two bottoms is the most critical factor in determining the strength of the support. A bottom that is tested after a long period, say 52 weeks, is far more significant than one tested after only 9 weeks. The longer the time, the stronger the foundation has become. Second, what is the geometry of the approach? Is the price descending at a sharp, aggressive 45-degree angle, or is it drifting down slowly with little force? A sharp decline into a support level is a sign of immense weakness. It indicates that selling pressure is powerful and organized. It is like a spear being thrust at a wooden shield. A slow drifting decline, on the other hand, suggests that the selling pressure is weak and disorganized. The sellers are losing their conviction as they approach the point of a known prior reversal. Third, what is the volume telling us? As the price descends toward the 470 level, is the volume of contracts traded increasing or decreasing? A true solid bottom is made on declining volume. This indicates that the selling is drying up. The supply of corn for sale at those low prices is being exhausted. Then, if the support is to hold, you must see a sharp increase in volume as the price begins to rally away from the support level. This confirms that new, powerful buying has entered the market. The combination of exhausted sellers and aggressive buyers is what creates a powerful reversal. To buy before this confirmation is to stand in front of a falling safe, hoping it will stop an inch above your head. The market is a study in cause and effect governed by natural law. These laws are as immutable as the law of gravity. To attempt to trade without a deep and thorough knowledge of them is to court financial ruin. You would not attempt to build a bridge without understanding the laws of physics and engineering. Why then do you believe you can build wealth in the markets without understanding its fundamental mathematical laws? Mathematical precision requires the correct textbook. Truth of the stock tape lays out the foundation for determining the trend of the market by analyzing the tape and the charts. It is not enough to read it. You must study it. The link to this edition is provided in the description below. These principles are not opinions. They are the codified results of decades of observation of markets under all conditions. Now, let us codify the rules for engaging with a support level. These are not suggestions, they are rules. Violate them at your peril. Rule number 1. Never buy on the first approach to a major support level. I will repeat this. Never buy on the first approach. This is the amateur's mistake. The first test is precisely that. A test. It is a point of reconnaissance. Your duty at this point is to observe, to measure, to analyze the time, the geometry, and the volume. To act is to gamble. You must wait for the market to prove that the support has held. Patience is not inaction. It is the highest form of disciplined action. Rule number 2. Demand the formation of a double bottom. A single point is not a foundation. A line is required. A true double bottom is one of the most reliable signals in the market, provided it forms correctly. Picture the chart of that December corn contract again. It touches 470 and bounces, perhaps for a few days or a week. This is the first bottom. Then the price declines again to retest the 470 level. The second low should ideally occur at the same price as the first or slightly higher. A second low that is slightly higher is a sign of strength. It shows the buyers are stepping in sooner than they did before. The price action between the two bottoms should form a clear, small rally. Most importantly, the time element must be correct. There should be a significant passage of time between the two lows, several days on a daily chart or several weeks on a weekly chart. A double bottom that forms over 2 consecutive days is meaningless. A double bottom that forms over 2 months is a concrete foundation upon which a great trend can be built. Rule number 3, volume must confirm the reversal. As I stated before, the decline into the second bottom should occur on lower volume than the decline into the first. This is critical. It proves that the sellers are losing their power. Then, as the price moves up and away from that second bottom, and particularly as it rises above the peak of the small rally between the two bottoms, you must see a decisive increase in volume. This is your confirmation. The market has spoken. It has told you that the support has held, the sellers are exhausted, and a new wave of demand has taken control. Now, and only now, is it safe to consider a long position. Rule number 4. Always protect your capital with a stop-loss order. Speculation is a business, and the first rule of any business is the preservation of capital. Once you have entered a trade based on a confirmed double bottom, you must place a stop-loss order below the low of that formation. How far below? This depends on the volatility of the commodity or stock. A general rule is to place it 1 to 3% below the absolute low. Do not place it exactly at the low. The market often makes one final sharp dip to shake out the weak hands before a major advance. Your stop must be placed outside of this zone of random noise. Placing this order is not a sign of fear. It is a sign of professionalism. It is your insurance policy against a catastrophic error in judgment. The gambler holds on, praying for a reversal as his losses mount. The professional accepts a small, calculated loss and moves on to the next opportunity, his capital intact. Rule number 5. Respect the rule of 3. A support level, like any other structure, can only withstand a certain number of tests before it weakens. The first test is for observation. The second test, forming a double bottom, is for confirmation and potential entry. If the market returns to test that same level a third time, you must exercise extreme caution. A triple bottom can be a powerful reversal signal, but it is also often the final test before a complete collapse. By the third attempt, many of the buyers who bought on the first and second tests are becoming nervous. Their resolve is weakening. If that level breaks on the third or fourth attempt, the subsequent decline is often swift and severe, as all of those trapped buyers rush to sell at once to cut their losses. Treat a third test of a major low with the utmost respect. It is a point of maximum danger and maximum opportunity. Now, let us consider the scenario where the rules are not met and the support level fails. This is just as important as knowing when it will hold. The failure of a major support level provides an equally valuable, though opposite, trading signal. Imagine our December corn contract approaches the 470 low, but this time it does so at a steep 45-degree angle of descent. Volume is not decreasing. It is expanding on the way down. This is a clear warning sign. The sellers are aggressive and in control. The price hits 470 and pauses for only a single day. There is no bounce, no rally. Then, on the following day, it opens below 470 and continues to fall. This is a clean break of support. There is no ambiguity. The market has not held the line, it has shattered it. For those who gambled and bought at 470, this moment brings panic and the potential for financial ruin. For the student of the market, it is a clear signal to stand aside, or for the experienced speculator, to initiate a short position. What happens when a major, long-term support level breaks? You must understand the psychology. Every single trader who bought at or near that support level is now holding a losing position. Their hope turns to fear. Their fear will soon turn to panic. As the price continues to fall, they will be forced to liquidate their positions, to sell. Their selling adds more pressure to the already falling market, creating a cascade effect. This is why the breakdown from a major support level is often so much faster and more violent than the rally that preceded it. Rallies are built on hope, which takes time to grow. Declines are fueled by fear, which spreads instantaneously. When support breaks, where is the next target? You must look at a longer-term chart. If you are operating on a daily chart, you must consult the weekly chart. Find the next major previous bottom on that weekly time frame. That is your next logical price objective. The space between a broken support level and the next one below it is a vacuum. Price will tend to fall through that area rapidly until it finds the next harmonic level where a new balance of buyers and sellers might be found. Another method is to use geometry. If the price was being supported by a horizontal line, its failure means a new, negative angle of trend has been established. You can draw your angles from the most recent top to project the new trajectory of the decline. A 1-2 angle, moving down 2 units of price for every 1 unit of time, is a common angle of a panic decline. These projections are not guesses. They are mathematical calculations based on the established vibration of the market. Let us synthesize this knowledge into a practical discipline. The study of support levels of previous bottoms is a study in market structure. You are acting as a structural engineer. Testing the integrity of the market's foundation. You do not assume the foundation is strong, you wait for it to prove its strength under pressure. Your process must be mechanical and devoid of emotion. First, identify the significant previous bottoms on your weekly and daily charts. Mark these levels. These are your potential zones of interest. Second, as the price approaches one of these zones, you switch from a passive to an active mode of observation. You do not act. You watch. You measure the time elapsed since the last bottom. You measure the angle of descent. You monitor the volume. Third, you wait for a clear pattern to emerge. You are looking for a confirmed double bottom with the correct time and volume signatures. If this pattern does not appear, you do nothing. The absence of a signal is itself a signal. It is telling you to stay out. Fourth, if the confirmation pattern appears, you may enter a trade. Your entry is calculated. Your position size is determined by sound money management principles, never risking more than a small fraction of your capital on any single trade. Fifth, immediately upon entering, you place your protective stop-loss order. This is not an afterthought. It is an integral part of the trade itself. Your entry and your exit are planned before you risk a single dollar. This is the work of a professional. It is disciplined, it is methodical. It is based on repeatable rules derived from the mathematical nature of the market. The gambler, the uninformed trader, operates on tips, hopes, and fears. He buys at a previous low because it feels like a bottom. He refuses to use a stop-loss because he is emotionally invested in being right. When the support breaks, he holds on, averaging down, compounding his error, until his capital is exhausted and he is forced from the game. The market is a relentless and unforgiving teacher. It will reward discipline and punish guesswork with perfect impartiality. A previous bottom is not a guarantee. It is not a safety net. It is a question that the market is asking of itself. Your job is not to guess the answer. Your job is to wait patiently until the market provides the answer in the clear language of price, time, and volume, and then to act decisively based on the revealed facts. To see the market in this way requires a shift in perception. You must stop seeing a random, chaotic scramble for money. You must begin to see the beautiful underlying geometry. See the cycles, like the turning of the seasons. See the ebbs and flows, like the tides of the ocean. See the balance and harmony, like a perfectly constructed musical scale. The previous bottoms are the key notes in this symphony. They provide the structure and the foundation upon which the entire composition is built. The uninformed look at a chart and see a jagged line. The student of the market sees a geometric proof. Study the laws. Obey the rules. Let time be your guide.